Hello and welcome to this episode of Standard Deviation, my column and video series. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint, and I'm going to be speaking to you about how, despite the success the RBI has seen with the turnaround in the banking sector, there are still several issues it must handle quickly. The Reserve Bank of India and the Ministry of Finance have effected a remarkable turnaround in the banking sector by reducing NPAs and increasing profits. But good work leads to more work. And now the central bank has to shift its focus from the macro fundamentals of the banking sector to more micro issues that are plaguing it. The solutions include bringing the myriad loan apps within the RBI's regulatory ambit, more effectively reining in unethical loan recovery practices, overhauling the regulation of cooperative banks, and figuring out ways to recover more from written off loans. At the same time, banks and NBFCs must also overhaul their thought processes and internalize the fact that they cannot operate as purely profit-driven organizations. The act of banking involves a social responsibility that they must honor on their own without the regulator forcing them to. But first, let's start with the changes that the RBI must make. The first relates to the loan apps. At the moment, these apps are preying on the financially illiterate and the desperate by promising no strings attached loans at exorbitant interest rates. The RBI does not regulate them and they take advantage of this. People borrowing from such apps often default on their loans or borrow even more to repay the initial loans. The RBI has rules regarding the appropriate behavior of loan recovery agents acting on behalf of its regulated entities. These rules, of course, do not apply to entities that are not regulated by the RBI, including the loan apps. Defaulters are harassed, often physically as well as mentally, through incessant phone calls and threats. There's a dual purpose behind bringing these apps within the purview of the RBI's regulation. The first is to set some limits on the extremely high interest rates that they charge. Yes, usually the loan agreement is signed willingly, but some leeway must be given to borrowers who are too financially illiterate to even know that there could be fine print in an agreement, let alone understanding what that fine print actually says. The second reason is from a broader economic policy perspective. The central bank has been raising the alarm over the rise in unsecured loans for a while now and recently took actions to curb this growth. But if we don't know how much is being lent by these loan apps, that leaves a hole in our understanding of the credit activity in the economy. Getting a handle on this data will allow policymakers to better estimate how much borrowing is happening due to income distress, how much is being borrowed for consumption, and how much is being defaulted on. Now, let's come to the cooperatives. Back in 2020, the RBI became the sole regulator of the urban cooperative banks. Since then, it has found numerous shortcomings in the way these cooperatives have been doing business and has even fined several of them. The print has shown through data as well as in reports from the ground how the operation of urban cooperative banks continues to be largely opaque, politically influenced, and unprofessional. It's time for the central bank to apply even greater rigor in the regulation of cooperative banks. These cooperative banks offer a vital banking service for people who don't have access to banks and NBFCs. These cooperatives are also often misused by local politicians looking for easy loans. Having cleaned up the indiscriminate lending by public sector banks, the RBI should now actively do the same with cooperatives. The third area that needs urgent and focused attention from the RBI and possibly even the Ministry of Finance is the issue of loan recovery agents. The RBI's rules are clear. Borrowers can't be harassed either in person or through phone calls and emails and can't be intimidated or harmed. The reality, unfortunately, is equally clear. A brief look at social media and online forums is enough to show you the enormity of the situation. Thousands of people cry out for help every day. Some are harassed and viciously abused on the phone. Others face more serious consequences like getting beaten up. The harassment and violence doesn't stop with the borrowers either. Instead, it extends to their families and friends. The RBI and central government need to urgently and forcefully clamp down on this. Of course, Defaulters can't be allowed to go scot-free, but beating them up isn't going to make them pay the money back. All it does is drive the victims to informal lenders such as loan apps and money lenders, who then drive them further into debt. Finally, the RBI needs to really figure out a way to recover more from written off loans or reduce the amount that is written off by banks every year. Write-offs increased to 2.09 lakh crore during 22-23, up from rupees 1.75 lakh crore in 21-22 and 2.02 lakh crore in 2020-21. The government has defended this increase by stating that write-offs are technical requirements as mandated by the RBI and that the recovery process on these loans continues. While that's true, it holds weight only if the recoveries actually happen to a satisfactory degree. If recoveries don't happen enough, the write-off process loses credibility and attracts criticism of being just another form of loan waiver. The good news is that recoveries from written off loans have been improving. In 22-23, banks recovered 22% of the value of the loans written off that year, up from 19% the year before and 15% in 2020-21. This improvement is creditable. But if the write-off process is to be credible, the growth in recoveries has to comfortably outpace the growth in written off loans. That is, if the RBI can't encourage banks to improve the pace of their recoveries, it must ask them to slow the pace of their write-offs. Now, all of this is what the RBI needs to do. There's also quite a bit that the banks and other lending institutions themselves must do. One of the key things they must do is to more strongly embrace the vital social function that they perform. It can't be that the RBI must constantly force them to do the right thing. For example, following the withdrawal of the rupees 2000 note, the RBI noticed a surge in liquidity within the banks as people went and deposited their notes with the banks. In order to absorb this liquidity during a period of high inflation, the RBI first gently encouraged banks to deposit their excess liquidity with the central bank, but this didn't work. So the RBI was forced to bring out the stick in the form of the incremental cash reserve ratio, which it announced in August this year. Now, this isn't a tool that is often used by the central bank. Instead of a suggestion, this tool forced banks to place their excess liquid cash with the RBI. It shouldn't have come to this. The central bank has shown itself to be an able regulator and to be alert to emerging stress. If the RBI is saying that excess liquidity could lead to higher inflation, banks should have been quicker to fix the issue rather than choosing to invest that cash in instruments that could generate higher returns for them. Similarly, the RBI has of late been periodically warning banks and NBFCs about the sharp growth in unsecured loans and has asked them to be alert to the stress that this could create. These warnings were ignored and unsecured loans continued to grow rapidly. The RBI was again forced to take steps in the form of a higher risk weight assigned to unsecured loans. Again, why did it have to come to enforced action? Banks, even private sector ones, can't be so overwhelmingly driven by profits. If they want to be treated like institutions of significance, they must act like it. The RBI still has a lot to do and can't coast on its past successes. But the banks and NBFCs too need to introspect about their vital role in the economy and society. On that note, that's all from me. Thank you so much for watching.